Central Bank of Nigeria and the Debt Management Office were pounding the market street, debt market as it were, this week. And the FMDQ exchange place is where we're taking this particular conversation. Right now, Bankole Odusoya, who is the head of fixed income trading at UBA, is live to us from there. Thank you, Bankole. It's good to see you. Thanks for coming on the program. It's a very busy and active week. How you guys survived between the Central Bank and the Debt Management Office, very active auctions and mop-up and all of that this week, isn't it?
Oh, yeah. Thank you, Boston. The activity on the bond end was being pushed basically by coupons received. Coupons on bonds received last week about 70 billion. This week we received another 38 billion. Such funds will be reinvested into bonds. So we've seen some activity on the short end of the bond market. I mean, 2027 bonds downwards. The other activity trigger we saw on bonds was the release of the issuance calendar by the Debt Management Office. This clearly states out their plan of how much you want to raise. We had envisaged they would want to raise more than what they issued on a quarterly basis last year, and this was what happened. So basically, market trended and reacted to that, even though it was a knee-jerk compared to what you would have expected. They plan to issue 150 billion every month for January to March, compared to what they did last year. In the last quarter, every month they issued or proposed to issue 115 billion. We know that in December they didn't sell much probably because of the Sukuk issuance and what happened. On the Treasury bill side of the market, it's been active on the short end, especially on the February to March maturities. For the long end, because of the amount of supply we're receiving from the OMO auctions, OMO issuance on a daily basis, there's little activity at that end. Rates have declined on the short end, like I said, but for the 180 days and 360 days bills, it's not really very volatile.
Yeah, it's not really volatile at the long end of the Treasury curve. So was that the reason why the Central Bank decided to sell more than 330 billion into that space?
Oh, yeah. If you listen to the central bank governor at the MPC, their target is to continually mop up liquidity and continue tightening the liquidity space on the local currency end, not just because of foreign exchange stability, because of inflation targeting. They emphasized seriously that even if foreign exchange was stable, they still have a good eye on inflation, which has a big risk of spiking. It's expected and has been said by some analysts that inflation could get to 13% this year. That's because of food and the trend of food inflation on it alone. But if you look at minimum wage discussions and the passage at the Senate yesterday, you will see that more money will be pumped into the system should that be agreed and paid at some point in the year. In the budget of 2019, that increase in overheads has not been included, but it could come in as supplementary budget. So when this happens, we'll be spending more, and demand pull inflation is sure to take place, and its multiplier effects also.
Okay, thank you. Nice one of putting it on the entire microeconomic space. But again, what would that mean for the debt market?
Well, we're seeing activities. We've seen some FPIs come into play. Honestly, this is surprising given the fact that we are just weeks away from the general elections. But it simply means that the rates are so attractive, some foreign portfolio investors do not mind coming in and probably just, looking at beyond the elections and the possible and potential drop of yields beyond elections, actually, because we have less than a month to go, and there may be a sharp drop upon the successful elections.
Okay, so what will be the playbook for next week with the January Naira debt auction by the DMO?
Okay, anticipation or expectations on the 2028, which is the only trading bond of the three they are issuing, is that rates should stop at between 15.5, where it's trading at in the secondary market, and 15.8 level, where it stopped in November. Thinking that it will get to, or expectations of rates stopping at 16 may be far-fetched, honestly, because the DMO is watching its debt service. Debt service to GDP ratio is quite high. We're spending about 60% of the national revenue on debt service already, and I believe they also watching that and won't be too aggressive in its mop-up of borrowed funds.
Okay, Bankole, so do you think the yield curve on Naira bonds have kind of plateaued, as it were? Do you see an inversion anytime soon, since you said it's not likely crossing into 16% level?
It's an inverse curve already. If you look at the one-year bills, whose effective yield are at 17.6, and bonds being flat at between 15 and 15.5. But if you're discussing about the bond end, I think that at 15.5 and 15.8, 15.9, we've seen a peak. Should we have successful election, like we expect, and then whatever comes out of it is being taken to judiciary by way of litigation, I believe the FBIs will kick in. The demand will drive down yields. I do not see 17% this time around. The last time that happened 4 years ago, it wasn't just political risk, it was also a big decline in crude oil proceeds.
So
That an FX challenge.
So post-elections, still within this quarter, January, February, March, if yields Naira bond you start to go down, do you think we still hold around double digits, or is likely the high end of a single digit level?
No, we're looking at double digits. The initial stage probably dropped to 14 to 13% level on bonds, and for bills we've seen huge drops to level of 11% at least.
Not significantly far from the NPR, isn't it?
No, not at all. That remains the benchmark, actually.
Enjoy your weekend. Bankole Odusanya, ahead of fixed income at UBA. And, of course, live to us from the FMDQ Exchange Place.